All right, guys. So let's move to the next question. This will be from your Kaplan's publication book, page number 9. Okay. So here is a question. This is about the preparation of a financial statement. Okay, or we call it as a published account. So whatever accounts we finalize and publish called as a published account. So let's focus on the question. Don't forget your basics. Okay, if your basics are strong, definitely you will be easily able to get out of marks from this question. The question says the following information has been extracted from the books of P for the year ended 31st March, let's say 2019. Okay, so what do we have here? We have administrative expenses, we have interest paid, uh, rupees are in thousands, let's say is a 5,000. We have the called up share capital, which is divided into ordinary shares of $1 each. Of course, it will have a credit balance. You know the thing, right? Every income and liability and capital, of course, will have a credit balance, while every expense and every asset will have a debit balance. So we can say that this is a list of debit balances and this is the list of a credit balances. So we have administrative expenses which will be form part of your income statement. We have the interest paid, of course it is an expense, will form part of the income statement. Called up share capital is part of your balance sheet or financial statement. Dividend is neither expense nor uh, it is an asset, even though it has a debit balance. Reason being, dividend is simply the distribution of a profit. I will let you know how do we adjust it. Okay, we have the cash and bank in hand 9,000, income tax remaining balance from a previous year. All right, so this is our asset. It must be a tax paid in advance or tax receivable. We have a warranty provision. What is the warranty provision? Let's say that when we sell something, or product or services, mostly the products, we provide some warranty. So we as a business have to incur some cost. So we do make a provision for that. Okay, so we debit our expenses and show that amount as a payable. And when actual expenses are incurred out of this provision, it get adjusted. Uh, we have a distribution cost of 240,000. We have land and building. Land have a cost of $110,000, while the building has a cost of $1 lakh, total of which comes to $210, wherein we have accumulated depreciation. The opening balance of depreciation is 48,000. All right. They will let us know what is the rate of depreciation. We have another fixed asset or non-current asset called as a plant and machinery, the cost of which is 125,000 and accumulated depreciation is 75,000. We have a retained earning, of course, the opening balance 270. 10% loan note issued, which were issued on in 2017. So we can assume, if nothing is given, we can assume and make a proper assumption whether it has been issued at the beginning of the year, or we can make an assumption that it has been issued on the mid of the year. If no further information about the date of issuance is provided, if they provide, we will act accordingly. We have purchases, we have sales, we have inventory on 1st April 18, means it will be opening balance of our inventory. We have trade payables and we have trade receivables. So this is nothing but a trial balance. Okay, now what next? They have given us an additional information. Inventory on 31st March, the closing balance of inventory is 250,000. Building and plant and machinery are depreciated. So we have three non-current assets. If you read the question carefully, we had land, we had building, and we have plant and machinery, out of which land will not be depreciated. While they say building and plant and machinery will be depreciated on the straight line basis, assuming that there is no residual value. So on cost, they already given us that building is to be depreciated at 5% per annum, whereas the plant and machinery will be depreciated at 20% per annum. All right. Even though they had not given this rate of depreciation and given us a life of the asset, we could have easily estimated the rate of depreciation and the amount of depreciation. There were no purchases or sales of non-current asset during the year. Non-current asset means what? Simply the fixed asset. It means whatever the opening balance at cost, the cost price and the opening balance were given, there is no sale of or purchase of any of the non-current asset. The depreciation charge for the year are to be apportioned as follow: 60, 20, 80, and 20, 100. Okay, so they are saying that there will be no separate line item to show the depreciation as an expenses, but those expenses of depreciation will add up to cost of sales, will add up to distribution cost, and will add up to the administrative expenses in the ratio of 6 is to 2 is to 2, or 60%, 20%, and 20%. Income taxes for the year are estimated to be 135,000. 10% loan note was issued on 1st April 2017. All right, rate of interest is given. So we have to calculate the interest part of the loan note. Loan note is our liability or borrowing in simple terms. The year-end provision for the warranty claim has been estimated as 75,000. So we already had some provision for warranty claim in trial balance where it is. Yeah, warranty provision is 90. Already we have a provision of 90, but at the year end, our experts assume that we only require the provision of 75,000. So it means we don't have to increase the provision, but we will have to decrease the provision. If your concepts on a double entry accounting systems are clear, what we learn already in the basics, I don't think it will be a big struggle for you. Now, what you required to prepare uh, P company statement of profit and loss for the year 31st March and statement of financial position. Profit and loss is the simple profit and loss what you learn in your uh, basics. But statement of financial position is nothing but a balance sheet. But we generally, unless otherwise asked by the question, do not use that word as a balance sheet, right? So how do we make a statement of profit and loss? So what will it have? Basically the format is important. You will have first revenue. I will let you know the components and other details. Okay, so once we have the revenue, we will subtract the cost of sales from it. We will get a gross profit. From gross profit we will be deducting distribution administrative expenses, which are the operating expenses, which are very much relevant to the operations. We will get profit from operation. Now just try to understand the flow and the concept. Figures we will work out. Okay, from profit from operation, then we will deduct the finance cost, which is considered as a non-operating expenses, which we already learned in the basics. What constitute the operating expenses and what constitute the non-operating expenses. So we will get profit before tax. From that, we will deduct the provision for income tax, and we will get the profit per year. So this is how we will derive our profit and loss account. Statement of financial position comprises of current asset, non-current asset, current liabilities, long-term liabilities, and the capital. So first we will be assessing the components of non-current asset, which will have property, plant, and equipment, including land, of course. Then we will have current asset, which will include inventory, our receivable means debtors, and our cash and bank balances. So once we get the list of current and non-current asset, we will be identifying the liability side of a finance statement of statement of financial position or balance sheet, which constitute the share capital, retained earning. Then we will have the non-current liability as usual, which include the 10% loan notes and long-term provision for warranties. Even though it has not been clarified whether it is short-term provision or a long-term provision, you can make an appropriate assumption and put it in the non-current liability portion or the current liability portion. uh, of course your marks will not be deducted if you make a suitable assumption. Okay, sometimes it depends on the nature of a business also, which you will learn later when we get into the details of accounting standards. Okay, so in then we have payables and tax liability, which are considered as a current liability. So now, if you understand the flow, we will have to make few workings first. So what? So let's make a format of statement of financial position and statement of profit and loss first. So just first start with the statement of profit and loss for the year ending 31st March 2019. So you'll have to make a table which will have the column for particulars. Amount, of course, we will keep it in 1,000. So you must have two columns, the inner one and the outer one for the amount. And make that amount column appropriate to put in the figure and particular column to put in the particulars. So leave, if you are using the pen and book, leave sufficient number of lines. You can make it a half page one. Similarly, we will on the remaining half page, or you can use the full page and use the next page for the statement of financial position. Of course, it will be as on 31st March or December, whatever is appropriate. All right. So if all these formats are ready, we just simply need to put in the figure and then we will be making our working notes. So now one by one, let's come back to the question. Start from the beginning. So they are saying that we have administrative expenses, we have already paid the interest, we have called up shared capital, we have dividend, we have cash at bank and hand, income tax, warranty provision, distribution cost, land and building, depreciation is already given, plant and machinery, retain earning, 10% loan note, and other relevant information. So let's start from the deriving the gross profit first. So we will have revenue. Revenue means nothing but a sales. So first of all, we have to make sure that each component, okay, from our trial balance has been properly covered. So where is the figure for sales? Yeah, this one, 1,300. Do we have any adjustment in sales? No. So you can simply put it in an outer column, use proper columns, commas wherever necessary. Less cost of sales. So what are the cost of sales? Cost of sales has the simple formula: opening balances plus purchases minus closing balances. But there is a catch. If you look at the question carefully, they also want us to adjust the depreciation in cost of sales. So unless we calculate the depreciation and its apportionment over the cost of sale, distribution cost, and administration expenses, it will not be proper for us to uh, perfectly calculate the cost of sales. So let's work out the depreciation part first. They have already done it here, but I will explain you in much details. All right. So our first working will be, let's call it as a working note one, calculation of depreciation. So again, make a table, particulars. We have land which will not be depreciated, but as it is a part of a non-current asset, let's mention it here. Then we have building and plant and machinery. And let's call this column as a total. So let's come back to the trial balance. Yeah. Land and building has a cost of 110. Land and building has a cost of 100,000. So let's mention cost 100, 110. Plant and machinery is 125. So this is done. So this 110 and 100, 210, and plant and machinery 125 is considered. So now also make a total of it. You keep your calculator handy. One hundred plus 110 plus 125, which comes to 335. Yeah, sorry, 335. We also have rate of depreciation. Given land will be depreciated at 0%. Let's come back to the question and read it carefully. It is given in an additional information. What is the rate of depreciation? Building 5%. I'm just marking in red whatever adjustment we have done. So when we, after completing a question, when we get back and check, have we missed anything? We will be assured that yes, the proper treatment for each information has been taken care of. So building will be depreciated at 5% per annum and plant and machinery at 20%. There will not be a total. We will call it as a depreciation for the year. It will be zero. Building, have I considered the figure here properly, or did I miss something? Mhm. Land 110, building 100. Okay, my bad. So you have to be very, very careful while reading the figures. So depreciation will be 5% of 100, and 20% of 125 comes to 25. So total depreciation is 30, and we will have closing WDV, closing written down value. 110 minus 0, 110, 95, and 125 minus 25 will come to 100. Total will be 210, 305. 110, 95, and 100. 210, yeah, 305. 95, 100. Plus 95 plus 110, 315. How it is possible? 110 plus 100 plus 125. It's okay. It's not 325, it's 335, and it comes to 305. You can help me out with the numbers and calculations so that we can be little quick. Yeah, fine then. Now, this is not an end word. You can always make your table look more proper. Presentation matters. Now, what is our opening accumulated depreciation? So we will have to get back to the question. Definitely will get it in a books. Accumulated depreciation here, in land and building, it has 48. So let's mention it 48. So of course it has to be balance of building only and not the land. And accumulated depreciation on plant and machinery is 75. So let's make a calculation again. 48 plus 75, 123. So we will have now closing accumulated depreciation. You can write with me, which will be the opening plus depreciation for the current period, 48 plus 5. So these two figure you have to add. Depreciation for the year will be added in the opening balance of accumulated depreciation. So we will get a closing accumulated depreciation. 48 and 5 will come to 53. 25 and 75 will come to 100, and total will be 153. So now the depreciation for the year is 30, but we are not going to show a separate line item for depreciation. So we can just call it as a working note too, or just can make a part of this working note. Let's say apportionment of depreciation. So it has to be apportioned separately on into three components. So let's get back to the question. They say distribute or divide your distribution in cost of sales 30 multiplied by 60%. 3 6 is 18. Then distribution cost 20%. So depreciation for the year is 30 multiplied by 20%. 3 twos are 6. And administrative expenses balance 20% will be 30 multiplied by 20% again 6. So total should match 18 plus 6 plus 6, 12, 18, 30. So okay, we also have the working for the apportionment of depreciation. You can, if you want, you can call it as a working note too, no problem. Make as much as working note you require. Okay. Now, what was our challenge? Why did we calculated the depreciation? Because we had to calculate the cost of sales. Now you can make a working note 3. So you should know the formula, right? To calculate the working note, to calculate the cost of sales. It is opening balance, add purchases, subtract, sorry, not opening balance, it is opening stock actually. Subtract, or you can mention add, can mention less. Closing stock. Even though this is a standard formula, we also have to deduct depreciation, or called it as an apportionment of depreciation. So let's get this figure from the books or trial balance. Where it is? Do we know the opening balance, opening stock? Yeah, we have it here. Inventory 150. Do we have purchases? Yes, we have 470. Do we know the closing balance? Yes, you should know that closing balance will never be form part of a trial balance, but it will be always given in the additional information. If it is not a thumb rule actually. In few of the questions, you will see that closing stock is forming part of a trial balance. It means the book adjustment has already been made for that. I will let you know in details how it happens. So just mark it so that we would know that this adjustment has been taken care of. 250. So we have to subtract, so you can simply show it as a negative figure. Less apportionment of depreciation on cost of sales will come to 18. Now work out the cost of sales. So pick up your calculator or your Excel sheet if you are working on. Will be 150 plus 470 minus 250 plus minus 18. It comes to 352. Numbers always should have the left hand alignments. Okay, so now we get back to our income statement. Less cost of sales, 352. You can mention here where have you calculated it. It has been calculated in working note number 3. Always put a proper references where you have made the working. So here we get a gross profit. 948. Check carefully if you have missed something. No, depreciation should be included into the cost of sales. 470, 250, 80. Did I make some wrong calculation? They say 470, 150, 250, and 18. 352, there comes to 388. I have made the wrong calculations, guys. 150 plus 470 minus 250 minus 18. 352. How do they calculate 388? What is their working note number one? No, it shouldn't. Kaplan is giving us a wrong figure or what? Yeah, there are plenty of printing mistakes in the books. 912. Can't be, no? 470 plus 150 minus 250. 60% of 13 is 18. Why have they added the depreciation here? Okay, we are increasing the cost. My bad. Okay, all right. They are correct. It has to be added. I tell you what. See, if you show a depreciation as a separate line item, okay, ideally it considered as an expenses which increases your expenses. So when I am reducing it from my cost of sales, I am reducing my expenses, which is not technically correct. So yes, it is correct. The figure should come to 388. Many a times, even if I can make a mistake, even you can miss this, and definitely the marks will be deducted. So if you still have any doubt, just feel free to ask me. So once we get the gross profit, now we will be identifying operating expenses. So I already told you, out of the expenses, which are the operating expenses, distribution cost and administration cost. See, hardly there are three, four expenses. Okay, interest is a non-operating expenses, administration cost is a operating expenses, and distribution cost is a operating expenses. So operating expenses will include administrative expenses and distribution expenses. 170 and 240. But we have to add a portion of depreciation. Now, I'm not saying that we have to less it. Depreciation is an expense, administration expense, cost of sales, all are expenses. So we will add up that expense in admin expenses, distribution cost, and already we have added the same into the cost of sales calculation. 240. It was 20% of 13 means 6 plus 6 plus 6. You can mention here depreciation. It's always good to put notes, references whenever you are solving the question. So 170 plus 6 comes to 176. If you have to deduct, you can always show it as a negative figure. 240 plus 6, 246. You can subtotal it. Total operating expenses 176 plus 246, 422. Keep it negative. So once you deduct operating expenses from your gross profit, you get your operating profit. 912 minus 422. Yeah, 490. From your operating profit, you have to deduct the non-operating expenses. Now let's get back to the question and see what are the non-operating expenses. Interest paid is a non-operating expenses. Share capital part of a balance sheet. Dividend is a distribution of income. Cash is the asset. Income tax will be deducted, of course, later. Warranty provision we have to adjust. Will it be considered as a operating or a non-operating expenses? Have they given something? Mhm. Yeah, this information. Warranty costs are charged to the administration expenses. All right. And yes, they also considered it, but they have not added it here. They have subtracted it. Why? So let me tell. You'll have to make a note of this. First, let's make this adjustment. Minus 15 warranty. What's the warranty to the administrative expenses? Why I'm subtracting 15? I tell you. 176 minus 15. 176 minus 15. 161. 161 246. 407. 505. All right. Now, why did we subtracted the warranty provision? So let's make a note for this. Call it working note 3. Working note 4. Adjustment of warranty provision. See, there are always two types of students. One who makes a thumb rule, when to add, when to subtract, and one who learn logically. So ideally, what we have to do, if you want to learn the accounting concept, you can always create an account, particulars amount debit side, particulars amount credit side. So we have opening provision of 90. They give us the balance required for closing provision. Provision always will have a credit balance, okay? So we learn this kind of adjustment in the basics. When we started basics, had a long session on basics, right? So to balance this account, of course, the higher side will be the balance side, 90, 90. To make it a balance, you will have to make an adjustment of 15. Now, what did you do in warranty provision account? To balance this account, you had to put a debit figure here, right? And the respective credit, the double effect will go to the P&L. Now, if you are crediting the P&L, are you considering it as an income or as an expense? Now see, warranty provision account, you have debited, right? So the respective double effect will go to the P&L. So if profit and loss account has been credited, it means it is an income. When it is an income, either it will have to show as a separate line item of a income, or you can simply deduct it from the expenses. And that's why this figure of warranty has been deducted, subtracted from the admin expenses. Great. Clear? Feel free to interrupt me and ask if you have any doubt. As this is the first full-fledged question on preparation of a financial statement, I want to go slow and steady so that you understand the process and the method. Okay. Now, once you understand the flow, let's get one by one. 10% loan note. Where are the loan notes we have? What is the amount of loan note? 80. They are also shown some expense as an interest paid. See, if I calculate, this is our liability, 80. There is no other borrowing or liability. So I can assume that this interest paid should form part of this 10% loan note. So 10% of 80 comes to 8. My expense for the year should come to $8,000 or pounds, out of which I'm saying that I already paid 3, 5, so 3 must be unpaid. So expense is 10, and if you look at the balance sheet, yeah, they have rightly shown the 3. So I will mention here interest cost. So you can say in bracket paid 5 plus payable 3, which comes to 8. Mhm. So you will have to make a note of that. To if you don't make that is also fine, but let's call it as an working note 5. Annual interest cost. You can better if you put it in a table. Annual interest cost. How will you calculate? 80,000 multiplied by 10%. Your borrowing is 80,000, rate annual rate is 10%, which comes to 10. Less paid given in trial balance 5. So payable will come to 3. Keep all these workings handy, and everything matters. If you miss even a single adjustment, it is not like they will mark your answer as a wrong one, but it is not a perfect one, so you won't get the out of marks. And you know, the account is a kind of a subject. Financial reporting FR is a kind of a subject in ACCA, where you can always score the out of marks. It's not that difficult, all right? Yeah, but while preparing the balance sheet, you will have to make sure that you properly show the payable portion of interest in a liability side. So coming back to the P&L. So we once consider the cost, we get a profit before tax. 505 minus 8 comes to 497. Now, if you deduct the tax adjustment from it, less you can say tax for the year. What is the information is given? Income taxes for the year estimated to be 135,000. Anything else? Okay. Now there is again a catch. In trial balance, they give us the income tax, which is 10,000. They say remaining balance from previous year. It has actually two meanings, that they have already paid in advance because it has a debit balance, or it can be that out of what was payable in previous year, which was not paid and not provided, has been paid in the current year. So if it is so, it has to be shown as an expense for the current period. What is they have done? So I will follow the Kaplan approach. Let's see if they have mentioned anything regarding this. Payable is they are showing 135. Even though I'm really do not agree to this adjustment, but let's go with this approach only. I will explain why did they do so. This information, the remaining balance from the previous year, they paid in this current year. So let's consider this as an expense for the current year, which is already been paid, and 135 is payable. So less income tax for the year, payable 135, which will form part of your liability, plus already paid 10, which comes to 145. And here you get a net profit or profit for the year, or you can also call it as a profit after taxes. In net profit after taxes, when we talk about the net profit, we always talk about the profit after taxes. 497 minus 145 comes to 352. So here our income statement is ready. We really don't use the inner column, but it's always a good habit to keep it as required. Now, simply start making the pick up the remaining balances and adjustment from the trial balance and make the statement of financial position. So we have the property, plant and equipment after considering the depreciation. You can always show the accumulated depreciation separately. So it is not a closing WDV actually, it is a balance. If you have some space remaining, just add one line here. Not required, let it be. We can simply adjust there. 305 minus 153. Hmm, 335 minus 153. So cost minus accumulated depreciation. 335, 153. So give a heading as a non-current assets. Cost 335 less accumulated depreciation coming from working note number 1, which is 153. Make a calculation. 335 minus 153, 182. In outer column, mention it. Then we have inventory. You can always pick from the trial balance. Don't miss that. Each and every adjustment need to be looked into carefully. For a depreciation purposes, we consider this and this. Then we have trade payable. Fine. Administrative expenses. Nothing. That's it. Only these are the non-current assets. Then let's come to the next part of current assets. Current assets will have inventory, receivable already given in trial balance. Okay. Inventory will always be a closing inventory. And of course, trade payables 60. Is there any adjustment in that? Sorry, trade payable is a current asset, current liability, current asset, trade receivable, inventory, and bank. Bank. This will not come, okay? This is opening balance. 728, no adjustment, no adjustment. Distribution, nothing, 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 nothing. 250 and bank without any adjustment. All right, mention it there. Inventory, receivables, and bank balance. 250, 728, 9. Which comes to 987. So you can make a subtotal here, this side. 182 plus 987, 1169. And now let's come to the another part of your financial statement, which is liability side. So we have share capital. Generally, this balance has not changed. So we'll pick this as it is from the trial balance and retained earnings. Now, make a careful attention towards the retained earnings. So your opening retained earnings were 270. Your profit for the year was 352, this one. And you have already paid a dividend, distributed a profit 6. So your balance retained earning will be 616. Here I'm not going to make a note of this because you make it on yourself. Let's just make it, name it the number, note 5, note 6. Written as it is already given there, just give the reference and mention it there. Working note number 6 and the figure comes to 616. So 200, 616 will sum up to the 816,000. And what else do we have in the name of a current, non-current liability? We have loan, we have provision for warranty, closing balance. I already explained you where to consider the provision. Loan is 80, provision for warranty closing balance as they required 75, it will come to 155. And we have the current liability, which will include our payables. You can show the separate line item for interest accrued and of course tax liability. Trade payable 60, uh, accrued interest payable, or you can say, I will just take it on a separate line. Yeah. Interest payable 3, no problem. You can add it there or here. Income tax payable or provision for income tax 135, which will sum up to 198, and you can have the total of a liability side. Eight one six. It should ideally match. Else you have missed something. Plus 155 plus 190. 1169. Matching. So here is a complete solution statement of financial position. Can take a screenshot of this. We have a complete statement of profit and loss, and these workings are important. So I hope the question is clear to you. Once you work more on basics, you can even more fluently solve these kind of problems in an examination. It's not a very big deal. So for today, let's say you can give it a try, test your understanding one on your Kaplan. Page number may vary based on the version which you are using and I am using. I have this on page number 13 here, from the books of Aaron. So give it a try, solve it. Let me know if you face any difficulties.